And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life with Lance Roberts. Presented by RIA Advisors.
All right, good morning. Technical difficulties to start out this Hump Day edition of the Real Investment Show. Of course, it is also Fed Day, and Oracle reports earnings after the bell today. So again, there's going to be a lot of questions surrounding Oracle's earnings. You know, are the earnings growing fast enough to assuage some of these debt deals that Oracle's been doing relative to building out data centers, et cetera? So again, this is going to be kind of a day to focus on at least what Oracle says, because again, that may have an impact tomorrow on what's happening in the AI space. At the same time, we will have the Federal Reserve today out after around 2 o'clock today Central Time, announcing their latest policy change, as well as the Fed press conference, which is going to be the most important thing. It's pretty much baked in the cake today that they will announce a 25 basis point cut. What's going to move the markets tomorrow is, or late this afternoon actually, but mostly tomorrow, is what the language of the press conference looks like. Is it more hawkish? Is it more dovish? What about rate cuts coming into next year? Interestingly enough, global central banks now have, after a series of we had just a record number of rate cuts being done by central banks globally over the last year or so. Those have all started to pause. So we now have a majority of global central banks pausing on rate cuts. The Federal Reserve now cutting rates here, maybe in 2026, but we could potentially see a little bit more hawkish tone towards maybe a little bit slower pace of rate cuts next year. I'm not saying that's the case, but this is what the market's going to be looking for. With the economy stable, again, we just saw some kind of off-the-run employment data over the last few days. We're starting to see a little bit of uptick in economic activity, starting to see a little bit of an uptick in employment. Nothing major, but again, it's not terrible. We're not in a recession. We're not on the cusp of a recession. We're just kind of muddling along here. So again, that may give the Fed room to kind of taper expectations about further rate cuts, at least for now, until we start to see either some economic pickup, which would lead to an inflation push that would potentially keep them on pause longer, or if we start to see economic deterioration, which would get them back into rate cutting mode. That's going to really be the big questions coming up into 2026. But we're going to get some language today. The markets are going to trade off of that tomorrow. So again, volatility here could be a little bit of a trick over the next few days. Outside of that, though, as I said, economic data is continuing just to kind of be muddled along. We saw the leading economic indicator index yesterday still negative. Very, very long stretch of negative readings for the leading economic index. But it certainly doesn't suggest that the economy is roaring by any stretch of the imagination, and that things do remain weak. The NFIB report came out a little bit weaker than expected. Sales actually ticking down just a bit. Employment remaining fairly stagnant and at fairly low levels. So again, just when we start looking at some of these economic data points, it doesn't, again, they're not necessarily suggesting we're in a recession, but it does certainly suggest some weakness in the overlying economy, which, again, the big risk going into next year is that earnings expectations are very elevated next year. And so those earnings have to come from economic activity. And if the economy is slowing down, that's the risk to earnings next year. And of course, if earnings expectations start to decline rather markedly because of slower economic activity, that's going to make this valuation issue in the markets a little bit more critical next year. So there's just some things to kind of pay attention to. This morning on the show, we're going to do live Q&A. Danny Ratliff joining me this morning, so you can ask literally anything. Financial planning, investing, economics, it doesn't matter. We'll answer those questions for you this morning and have that discussion. But real quick, let's go take a look at the markets. Here's what you need to know before the bell this morning. Markets traded fairly flat yesterday. We traded up kind of most of the afternoon, finished today kind of fairly close to even. Not surprising, again, we talked about this yesterday. We're just at the top of this trading range that we've now been in for the last really kind of several weeks here, really going back to mid-October. So not a lot has happened, with the markets, here for a while. After this very big run that we had back from April, market just continues to trade sideways, as we discussed yesterday. don't be surprised if you get a little bit of sloppy trading this week. And again, with the risk of the Fed, we might see this market sell off a bit tomorrow. That wouldn't be surprising. Bring us down to around the 20-day, 50-day moving average, where those are starting to converge here. Decent level of support. So again, a bit of a pullback tomorrow on disappointing Fed announcement or potentially Oracle's announcement this afternoon. That wouldn't be surprising at all. Markets are a little bit overbought here, so again, kind of working that off. We're still on a momentum buy signal, but that's starting to show a little bit of weakness here as well. So again, there's certainly some risk here of this kind of continued sideways pattern here, a bit of a pullback, then a rally into year end. Again, nothing really too much to be overly concerned about, but something at least worth paying attention to relative to risk in your portfolio. And if we take a look at the VIX, we're starting to see kind of a similar kind of look here that suggests that we may see a little bit of weakness here, at least in the short term. The MACD, the momentum signal on VIX, is after this big spike that we had back in November, we've completely reversed all that back down into the 16 range that we had here just a few days ago coming out off of Thanksgiving. The momentum indicator got fairly oversold here, starting to turn up. So we may actually see a little bit of a VIX buy signal, suggesting a little bit higher rate of VIX. So I mean, a move back up to 1920 on the VIX, that wouldn't be outside the realm of possibility, but that would also coincide with a bit of a sell-off in the markets here short term. Now again, you could have a bit of a sell-off here, and that still sets you up for that kind of year-end rally, just the last 5 days of December, first 2 days of January, as we start getting positioning put on books for end of the year closeout. But again, we're starting to see a little bit of a pickup in the VIX, so at least worth paying attention to in terms of risk management here. So if you've got aggressively long positions, and again, we've seen some of the more retail favorites, Applied Dynamics, Oklo, others over the course of the last few days having fairly big moves. You might want to think about just taking a little bit of risk off the table. Again, just kind of as a proxy of that, we've talked about Bitcoin. Bitcoin's been on a nice little trade here higher, but that's also starting to show, this has been a very weak rally here. So again, we're getting this rally. We talked about this a couple of weeks ago that Bitcoin was very oversold, good kind of an entry opportunity for a trade. That trade's been working okay, but you're about to start running up into resistance. And with the VIX starting to show a little bit of a sign of an uptick, there's some risk here. Again, just kind of this risk on trade we've seen is showing a little bit of weakness. So again, just be a little bit cautious with your portfolio. Maybe take a little bit of profits, kind of rebalance some stuff, here just for the next couple of weeks, just to kind of navigate through this. And then once we start getting into the end of the year, we'll start getting a little bit better outlook where we are technically, and particularly as we start to move into the new year. So that's what you need before the bell. That's what you need to know this morning before the bell. Now, when we come back, let me change sets here real quick, and we'll pick up with Danny, and we'll take your question and answer. So type your question in the chat. Danny's going to be monitoring that real quick for me, and we'll start answering questions as soon as we get back. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economics Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, good morning and welcome back to the show. Of course, Danny Ratliff joining me this morning. Danny, how are you, sir?
Hello, good morning. Doing great.
Getting ready for the Christmas holidays?
You know, the best we can.
Santa Claus is almost here.
Santa is almost here.
So, yeah, we told our kids growing up the day they stopped believing in Santa Claus is Santa Claus stops coming. So
well,
that worked great. They lied for years.
We are there now. My oldest is like, my middle one's the one who's giving us a bunch of grief, and he is letting everybody else know. And the oldest is like, what are you doing? And she won't say why, but I think she knows. Because she knows, hey, that Santa train stops quick.
Yeah. Well, no, the problem is you have to deal with people at school, right? So. Yeah. It makes it tough.
No, for sure.
All right. Well, let's get into some questions this morning, Danny. What we got working on?
Got a lot of good questions, and so kind of jumping around a little bit. But obviously, big day today, the Fed meeting. So one of the questions was, has the Fed given up on its inflation mandate?
Yes. Yes. Yeah, they won't say that openly, right? But they're supposed to be their target. They're supposed to only have two mandates, which are basically inflation expectations, keeping price stability, and full employment. And we've seen more of a shift to that really since 2008. Even though they continue to say that their mandate is price stability and inflation, their real mandate is creating the wealth effect. Yeah. And what they figured out after 2009, and we've stated this before on the show, so this won't be new if you've been watching the show for a while. Ben Bernanke back in 2010 specifically said in a speech, he says the reason we do QE is to raise asset prices to boost the wealth effect, which helps economic growth. So this is why you see, despite the fact that if you're concerned about inflationary pressures, et cetera, they're not really focused on that. They're focused on making sure that the financial system is operating functionally. Again, we've just talked recently about the lack of liquidity. The Fed now has stopped QT and has restarted. Basically, they have not started QE, right? So let's just say that they have not started QE, but they will purchase about $45 billion worth of bonds this month as mortgages roll off their balance sheet. They've got to keep their balance sheet stable. So there's going to be a lot more activity and of providing liquidity to the markets. So when they provide liquidity, and this is what we talked about before, the Fed does not print money. So let's just solve that problem right there. They create reserves, and those reserves get lent to whom? Hedge funds, pension funds, insurance companies, et cetera. So anybody that can access the overnight window, that's where those reserves come into play, creates leverage for the markets, and so that's how liquidity gets itself back into the markets, and why the banks are looking for more assistance from the Fed.
So obviously today, being that we're going to get a lot of information, do you anticipate a sell-off like we've been seeing last several times, or
who knows? It just like I said before the wrap, it just really depends on
forward guidance, really, from
it
Powell.
really does. It really depends on what Powell says. If Powell comes out very hawkish, and look, he's about to lose his seat, so it looks like right now that Kevin Hassett is odds-on winner, that he'll take the place of Jerome Powell next year. So Jerome Powell is not a fan of President Trump, I don't think, at least from past comments. He doesn't seem to be a fan of President Trump and the policies. So, him coming out today and saying, hey, you know what, we're going to just put a pause on rate hikes, whatever. Again, anything that leans more hawkish is going to potentially have a negative impact to the market. So yes, I would expect either late today or tomorrow for there to be a pickup in volatility in the markets. And we're already seeing that. The VIX has been rising for the last 3 days, as I was just showing you a second ago. So yeah, I would definitely expect that.
So June's dot plot or September's was suggesting 3 to 3.25 on Fed funds rate. Now it looks like they may change that to 3.5 to 3.75. Yeah. What is that? What's the impact on long bonds right now? So I think that's the big question. And not that has anything to do with it, because that's going to be controlled by the Fed short term. Long bonds are going to be inflation and growth controlled. But what do you anticipate there?
Like after today's announcement?
Well, just in general over the next 6 months.
Rates probably aren't going to go anywhere.
Yeah.
Yield
curve will likely steepen.
Maybe a little bit, depends on economic growth.
Yeah.
Right. So again, it's just when you start talking about the long end of the curve, it has nothing to do with the Fed. It has everything. The only thing that drives that is inflation and economic growth. So if economic growth is going to chug along here at 2.5% ish, right? You get inflation chugging along at 2.5% ish. So you're going to run about 4% interest rates, 4.25. So you're just going to kind of, you're going to be stuck there as long as we're kind of in that range. But again, all the economic data suggests that next year we're going to see slower economic growth. And unless this whole AI boom just really manifests itself through construction and build out and those type of things, maybe we get a bit of a push there. But 70% of economic growth is consumption. So even though we'll see some economic benefit from all the data center build out, that'll definitely happen.
Yeah.
But still 70% of the economy is consumption. And the consumers are certainly showing signs of slowing down. They're not collapsing, but they're certainly showing signs of slowing down, which again, that's going to keep economic growth suppressed. So if you've just got 2% growth, 2% inflation, you're going to be running somewhere around 3.5 to 4.25 on interest rates next year.
And that would include the 10-year bond, you think?
That's what I'm talking about specifically, not include it. That's what you're talking about. Because short end of the curve, that's going to be Fed.
Yeah.
So everything, really kind of 5 years and in is going to be more closely associated with the Fed funds rate. Just the 2-year and the Fed funds rate run very, very close together.
Yeah, no, that makes sense. So kind of switching gears a little bit, obviously you just mentioned the tech bubble. Lots of questions on that. Do you think that AI has healthy growth in 2026, that potential for it, or do you think that maybe we're going to see that sector rotation?
Well, no, you're talking about two different things. So we're talking about
I know you're going
growth.
to say there's no healthy growth, but
Well, no. Are you talking about growth in earnings, or are you talking about growth in price?
yeah.
Yeah,
Well,
what?
I think most people are probably concerned about growth in price, right?
I guess, yeah.
Well, I mean, nobody really cares about earnings as long as the stock's making money.
Well, yeah, but when you say, do you expect healthy growth in the AI sector? Yeah, it's going to boom next year.
Yeah.
I mean, they're building like crazy. It's just, we've talked about stuff here on the show that's happening, from data center build outs to energy consumption to everything else. That's all has ancillary impacts on, the economy. But yeah, their earnings growth is going to be stellar at this point. There's nothing showing any signs of that slowing down right now. Now, the big question is whether or not CapEx continues to grow at the rate, or do companies at some point start to pull back on CapEx and say, well, we're not going to spend as much as we get. That's the risk. Any kind of disappointment, on that front is going to be very impactful to that AI trade.
I found it interesting. A couple of weeks ago, we saw tech getting beat up a bit, and everybody was concerned about fundamentals all of a sudden. And do you think that's something that begins to kind of pop up, or is that just a short-term narrative from an overbought market?
That's always narrative.
Yeah.
I mean, that's why, every time the market has a little bit, we have a 30% run in the markets and you have a little 5% correction, everybody's like, oh, it's the end of the AI trade. That's just narrative. All this stuff, again, we talked about this before, is that when markets are rising, nobody cares. So we come up with reasons why market, whatever asset price it is, right? Whether it's gold or silver or, stocks or bonds or whatever, as long as it's rising in price and it's good for us, we're like, oh, this is great and it's going up because of this reason. And as soon as there's a correction, right, we've got to have a narrative as to why. It's just human nature. We have to rationalize why things aren't going the way that we thought they were. So again, as long as things are going up, we're great. It's just we have to rationalize these things when they go through these corrections. So again, there's that's why it's always important not to pay attention to the narratives, just pay attention to the price action, because at the end of the day, that's all you really care about is, are you just having a correction within a bullish trend? If so, buy more. Or are you breaking trends, and has the market now determined that there's a different valuation metric for whatever asset it is, whether it's Bitcoin or whether stocks or whatever? Those are the things you need to be paying attention to. Discard the narratives. The narratives are rarely right. Those are just after the fact rationalizations for why something's going up or down.
Yeah, no, that makes sense. So you touched on the growth we see in AI and the technology sector, data center build out. Java Joe had a great question. It says, do data center owners use project cost models which assume electricity is going to be subsidized by basically us? That's already essentially happening. Mm-hmm. But how do we envision that moving forward, and what is the overall impact with the enormous amount of consumption that these data centers require? Is that something that we'll always subsidize, or is that going to be subsidized by government?
What do you think?
Oh, I think we're paying for it now.
Yeah. Do you think it's going to get subsidized?
Absolutely.
There you go. You don't have to ask me all these questions. You're free to answer some of these questions on your own. Like the one on the one big beautiful bill, right? So that's important.
Yeah, well, so that's an interesting one, right? So what is the impact going to be on the one big beautiful bill to the economy? And right now, probably not a whole lot. If you think about it, the tax code has been relatively unchanged. We just made it permanent. Now, how permanent that actually is, we'll see what happens if the pendulum swings from one side to the other side of the aisle. And we could very easily see taxes change in 4 to 5 years. Depending on what happens with elections. The biggest things that occurred with that is essentially we got a lot of stuff extended with the Tax Cuts and Jobs Act. We were able to lift that SALT deduction up to $40,000 this year. So that's really good news for a lot of people who are unable to deduct that state and local income tax. The other aspect of it was enhanced bonus depreciation for businesses. They can depreciate things much quicker. So while that is likely good on the balance sheet of corporations and companies, small businesses, there may be some other, it's probably not going to be the overall big boom that we would hope for looking at a tax bill like we just saw. Outside of that, you can depreciate now, deductions for car loan interest. Now, one big thing, and we are end of year, and so a lot of you guys are charitably inclined, there is going to be a new caveat associated with, so you can do above line deductions in 2026. So meaning take the standard deduction. If you're single, you can take an additional $1,000 for charitable gifts. If you're married filing jointly, you can do $2,000. But here's going to be the caveat. If you're itemizing, it has to be above 0.50 of AGI for you to be able to deduct it. So take your income, do that 0.5. Anything above that amount, that is what you can actually deduct on your income taxes. Those are probably the biggest things. I don't see anything in there that's going to suggest like, oh, wow, we've got some great economic boom coming. Now, I think what would be more beneficial is if they were able to actually do something with the corporate tax rate. That would likely spark economic growth. However, that would be a year over year, just like we saw in 2017. Tax Cuts and Jobs Act was actually passed. 2018 was one of the best years. In fact, we saw the two best consecutive quarters we've ever seen for earnings. Mm-hmm. And that was simply a function of math, that all of a sudden they have a lot more money in their pockets, not paying taxes. A lot of funds were repatriated. So I don't see that aspect. Lance, do you see anything more?
No, really. That's one thing that we'll see next year is just, when there's more certainty around tax codes, that gives the ability for companies to do CapEx.
Yeah.
Right. With the one big beautiful bill, what that does is that provides at least some near-term certainty. So companies can go out, they can hire, they can do CapEx, they can do these build outs because they know what they're dealing with. When it gets tough on the economy is where there's a lot of flux. And one of the things that we're going to have to deal with this year is midterm elections, right? So right now, everybody's just assuming everything's status quo and everything's fine going forward. But the midterm elections are going to be worth paying attention to, because if the House or the Senate flips, then all of a sudden getting bills passed, getting that thing even becomes even more difficult. I mean, it's difficult enough as it is right now to get something passed, but it will become even more difficult if we get into gridlock. So that's one thing to, for a lot of the agenda that President Trump wants to do in terms of, the economy, a lot of that could come to a halt after the midterms this coming year, potentially. And so it's at least something worth paying attention to.
Yeah. So,
and speaking of that, real quick, there was a question about how much tariffs have been collected so far. As of fiscal year 2025, the U.S. collected about $195 billion in tariffs. So,
not pocket change,
it's not pocket. But you got $35 trillion in debt. $195 billion is not going to go a long way.
It's going to take us centuries to pay it off.
Yeah, but it's $195 billion worth of revenue we didn't have before. So it's not nothing, right?
Well, but for the average Joe out there, they're the ones facing the brunt of this. I mean, at the end of the day, you can say, okay, well, so big question I've received lately, it's not in the chat, but okay, what is the impact if you actually went away with taxes? President Trump has mentioned that a couple times here over the last month. So, it's potential we could just do away with income taxes. Okay. Well, so what takes its place? Well, tariffs. So then what happens? All the prices go up. Therefore, you're still paying that tax one way or another. It feels a lot better because you're bringing home more money in your pocket, but everything else is going up. So if you don't get wage growth going along with that, that's where it becomes problematic. And now, I'm not advocating and saying I like taxes. Trust me, it's the hardest check you ever write is the one to Uncle Sam, unfortunately.
Yeah.
I think most of us are much better stewards of capital.
Right. But look, it sounds great in thesis. I mean, but we collected $4.9 trillion worth of tax revenue.
Yeah.
And it's going to be hard to replace that with $195 billion in tariffs.
So what would you actually have to do with tariffs to get that even be close to it? And imagine what the inflation would be at that point.
Well, again, it depends on who eats the tariff, right? It's not the consumer. Right now, and clear evidence is showing that the producers have been eating the tariffs because they can't pass it on. So the question is, and the only way you can pass it on is if you have strong economic growth in order to be able to allow for higher wages and inflation so that you can pass it on. And that's the problem for a lot of these
And
companies.
that's the biggest difference with inflation from the 70s and 80s to now, right? Because you had wage growth going up. You also had a much different economy. You had manufacturing versus the service. And so that's a question we get often. Is like, well, what makes this different? I remember the 70s and 80s. Well, there's a lot of differences.
Right.
So, all right.
There was a question. Oh, there was a question here real quick. I've lost it now. Go get. Okay. Go ahead. Keep going. Oh, that's why I mind explaining what 3 standard deviations are. We've written some articles. If you go to our website and type in Bollinger Bands in the search bar, you'll also find articles we've written about standard deviations and importance of that. But when you think about standard deviations, we're talking about a normalized bell curve, and you'll see these kind of graphics a lot. When we talk about risk, you have tail risk on one end, tail risk on the other, and then most of your activity happens in the middle of this bell curve, right? So if you just think about a normal bell curve, the vast majority of your outcomes are going to occur within that kind of that middle part of the bell. That's where everything occurs. So when you look at standard deviations, if you split that bell curve right down the middle, that's positive and negative. From that center point, you have positive and negative. So about 95% of all activity is going to occur within what's called 2 standard deviations. So it's 1 standard deviation on each side of that bell curve. So within that 2 standard deviation range, that's about 95% of action. 3 standard deviations encompasses about 99% of all that action. Once you get to 4 standard deviations, you're at 99.999%. 5 standard deviations, you're 99.99999. But I mean, just, you're talking about once you get to 3 and 4 standard deviations, you're starting to get out on the edges of that bell curve, right? And that's what we call tail risk. So if you just think about stretching a rubber band in one direction, if you stretch a rubber band and where it gets kind of taut, and that's where it's like starting to get kind of hard to pull it, then that's 2 standard deviations. 3 standard deviations is now you're really starting to stretch it, right? I mean, you're starting to maybe see some cracks in the band. That's the stretch of 3 standard deviations. So that's why it's important when we talk about, things are moving 2 and 3 standard deviations away from their means. That's why you eventually always get those corrections. So again, there was a comment about silver a second ago. Silver's trading 4.5 standard deviations above its long-term mean, right? It's had these kind of spikes historically before. It always crashes after these types of spikes because it just can't sustain that type of move price-wise for very long. So if any sellers show up, you're going to get a very, very sharp reversal in the price of silver at some point. Again, it's great right now. We were talking about this earlier. It's great right now because it's going up. So if you're long silver, you're making money like crazy. Don't forget to take some profits along the way because you've stretched that rubber band now. You're even more than where the rubber band's starting to show some cracks. You're way out there. So eventually that rubber band's going to snap back. And if you just go look at a long-term chart of silver, you'll see these spikes historically. They always correct 70, 80% of those spikes. So just, again, that's why it's important to pay attention to these technical deviations because they always result in a reversion. Not if, not maybe, always result in a reversion at some point. And again, that's the big thing. A reversion at some point. It doesn't mean tomorrow, doesn't mean next week, could be next month, next quarter, but it always results in a reversion at some point. So good question, though.
Yeah, no, really good question. So while you're on that type of, we're on that vein here. So trying to get smarter on money flows, leverage, credit risk, and liquidity in public and private markets. What indicators, data should I look at and track to help get smarter on this? This is a good one. There's so many. There's so much.
Well, the problem is there's not one for any of these, right? I mean, this is why we pay for data sets of. We have massive data sets that we can draw on, but to look at money flows, you need to look at money flows, right? So how much money is flowing into or out of ETFs as a whole, how much money is flowing into or out of money fund mutual funds as a whole. You can get that you can get some of that data from ICI.com, which is they track all the money flows into ETFs and mutual funds. In terms of credit risk, you take a look at leverage, you look at margin debt, you look at the amount of levered ETFs that are trading in the open market, how much AUM is in those levered ETFs. Take a look at credit spreads, particularly your investment grade bonds to your junk related bonds and take a watch on credit spreads. That's why, on SimpleVisor, we track credit spreads on SimpleVisor just for that reason. And, liquidity in the public and private markets, you can't really track that too much because it's private. But what you can look at is how much money is in AUM of private equity funds, private credit funds. That data is out there. But again, this is, stuff you're just going to have to hunt to try to get a hold of that data. There's not just go watch this one indicator. It tells you everything you need to know. I mean, this is why Mike and I spend our entire day just monitoring, data sets, writing articles, doing other stuff. And we write articles about this stuff all the time. So again, if you want to keep up with what's going on this stuff, read our weekly newsletter, go to our website, read our blog. You can subscribe. We'll email them to you as we produce them. But we're constantly writing about this stuff and putting it out there for you so that you can kind of keep up with what's happening in the overall market. So again, it's a good question, but it's not, this is something that is not that's not a simple solution to that question. There's so much data out there that is available. You just got to go find it, or most likely you're going to have to pay for it because it's not free.
Yeah. So a couple of people mentioned that inflation, kind of disagree with that analysis on inflation in the sense that tariffs are not necessarily causing inflation in the sense of that the consumer's paying for, that the producer's actually eating that cost at the moment. And I think one big thing to think about is that we're going back to when were tariffs enacted, the beginning of this year.
Right.
And most of that cost that you're seeing right now that you're paying when you go to the grocery store, everywhere else that you go, that's already been done. And a big portion of that was because of what has essentially happened during COVID, all the stimulus, all the things that occurred during that time. And what we're seeing is the delta, the change in it is going up much slower. So what you're really talking about, we're talking about disinflation versus deflation. And we really don't want that deflationary aspect because inevitably that means that you're going to the store and paying less, which means we're going to be in an economic turmoil, a time of, where everybody's lots of people are looking for jobs. It's not a great scenario. And so I get it. I understand your sentiment. Everybody feels it. But the tariffs, if we look at that, if what was PCE was 2.8, what are the other numbers were all relatively in line and nothing that has been shocking to the upside where it's like, whoa, okay, we've seen massive increase in inflation because of tariffs. All that stuff's been baked in.
Well, no, and the other side is that, people are mistaking two things. One, what's the source of inflation? Mm-hmm. And two, what's causing inflation? And there's two different things. Look, yes, prices are going up. They will always go up because we have economic growth. And as economic growth goes up, you're going to the store, you're buying stuff, you're creating demand. So every time you go to the store and you buy food, right? If you're buying, if food sales are going higher, corporations are going to go, I'm going to charge a little bit more because I just sold out of everything I had at $2 a dozen for eggs. I'm just picking a number. So I'm going to charge $2.05 next time. Right. And so you'll pay that. And then they'll say, okay, we sold out of everything there. So we're still good. We'll go $2.10. And so prices go up. But that's economic growth. So as your wage growth goes up, as economic growth goes up, you're going to get inflation. If you're not getting inflation, this is why the Fed wants 2% inflation. You have to have inflation to have economic growth. If you don't have inflation, if you don't have prices going up, you don't have economic growth. And if you don't have economic growth, you're not getting wages. You're not getting, better lifestyle. Your wealth won't be growing. So yes, inflation is a byproduct of, and it's a result of your growth in the economy, your increase in wealth, your economic prosperity is all reflected by what's happening with inflation. What you don't want are big spikes of inflation that are above the rate of economic growth. That's what the Fed doesn't want. So now you've got some type of esoteric force that's now weighing on the economy and creating inflation spikes, i.e. the oil embargo, right? Back in the 70s when we had that big inflation spike, oil was shut off. We couldn't get to it. So it created an inflationary spike in commodities because of the oil embargo. That wasn't a function of economic growth. So we don't want that. That's bad, right? That type of inflationary spike is bad. What you do want is you do want inflationary pressure in the economy, 2.5%, 3% growth in inflation. That's a very healthy thing. You want those to be growing along with the rate of economic growth. So don't confuse inflation as a bad thing. You want inflation. It's good for you. What you don't want is a spike in inflation caused by some event that is now impacting both producers and consumers simultaneously because of a lack of access to some product, service, or good. So again, this is the big confusion. Everybody talks about inflation, but they really don't understand inflation. And yes, we conflate that with higher prices at the stores. Like, oh my gosh, I'm paying more. Yes, but your wages should have been going up too. And we are seeing wage growth in the economy.
Yeah, so kind of interesting. We're getting a lot of silver saying that's advisors' kryptonite.
No, silver's great.
Yeah.
Just don't forget to take profits in it.
Well, and that's the thing right now, right? I mean, many people are struggling to take profits. And in fact, I've had some discussions where we've broken it down. They say, well, and so going back to kind of looking at those standard deviations and how far elevated they are above moving averages and their means. And when we started doing the math, a small move, say in gold, for instance, some people are saying, hey, I don't want to do this because I don't want to impact my IRMA, right? So your Medicare premium surcharge if you make too much money. And we started doing the math, said, listen, here's how much you're going to pay in this. But if it went down by 5% with the amount you have, it'd be better off for you to pay the tax and reap the rewards of it. You don't have to sell it all, but begin to have a strategy for that. So start thinking about that. I think that's one thing when companies get really elevated and we kind of like, oh, well, we'll let them keep going. We'll let them keep going. Many people get kind of that paralysis by analysis and also that fear of missing out in the sense they, I can't sell now. It's been so good. We're going to keep it going because I don't want to pay the taxes. And I think this is a really good instance where it'd likely be good to start taking profits at some point. I get the sentiment. I hear it. I understand it. However, we also know what likely happens. And I always bring it back. Lance, you can remember this, and we may have talked about this a while back, but all these people that are hawking gold, for instance, we'll pick on that for a minute. Aren't they selling it?
Yeah.
And they're for-profit businesses, right?
Yeah.
So if you actually owned it, which many of them don't, right? Many of them are the middleman. But if they actually physically owned it, why would you sell it if you think it's going to the moon? You wouldn't. You'd sit on it.
Yeah. Nobody ever thinks about that.
No.
Brent, bring up this chart for me. This is a chart of silver. This is what I'm trying to tell you about. So we were just talking earlier about 2 standard deviations, 3 standard deviations. This is a chart of silver going back to 2006. This is just using SLV, the commodity, and the ETF. But currently, this is a monthly chart of silver prices when it, as compared to its 48-month moving average. So that blue line in the middle, that moving average, is its 48-month moving average. It's 4-year moving average. You're currently trading above 3 standard. You're in the 4 standard deviations above that long-term moving average. And as you can see, when you've done this previously, going back over this period, you've always had very significant corrections when that bullish exuberance, ultimately subsides, and it will. You're just in the middle of what's called a melt-up phase in the commodity, which is fine. There's nothing wrong with it. We're long silver and gold, and our commodities portfolio. It's doing fantastic. We love it, but we're going to trim profits along the way because when this reverses, it's going to reverse fairly quickly. And whether that happens, next year, next month, who knows? It could be 2 years from now. These things can last. Again, this is a monthly chart, so it takes a while for those things to mature. But eventually, that reversal always happens because you just can't sustain that deviation from the long-term mean because the mean is the average. The mean means that in order to have that mean, the price has to trade above and below that. So it acts like gravity ultimately, and you will have that reversion back to the mean. It's the most powerful force in investing, and it will never change. And that's just the way markets work. So again, this is why it's important. Doesn't mean sell everything, but make sure you're taking profits, rebalancing your risk, looking for other opportunities that haven't moved yet. So.
All right, here's a good question. Is buy and hold diversified ETFs a good passive investment strategy?
Mm-hmm.
It can be, and I think it's really dependent on valuations. We have a much different take than probably mainstream media or financial advisors in the sense that we understand the math of loss and risk. And so there are times where, yes, if you put money every month into the S&P 500 over many, many years, it's likely going to do very well. But, I struggle with the word of diversification in some ways in the sense that, most advisors are going to look at modern portfolio theory. And we're going to go back, how many years ago was that created? Over 50 years. How much has changed in that time frame? Mm-hmm. And somebody mentioned cycles, how much quicker we're seeing things occur. And so, that would suggest, and most places are going to say, hey, we're going to buy large cap growth, value, mid cap, small cap, international, emerging markets. And we're always going to hold every asset class. But we really like it. We may overweight it a little bit. If we don't like it, we'll just underweight it a little bit. But we're always going to hold it because we don't know what's going to happen. And it's an easy way to invest. But what if we know, or we really have a high conviction that something's going to go down? Why would we remain in that position? And so where that buy and hold strategy is great for long term, and if you're starting off with a small portion and you're continuously investing, kind of that dollar cost averaging, where I think it gets to become maybe at a little bit of a disadvantage is when you're taking distributions. When we're in market times where valuations are extremely extended. And we know, as Lance has talked about, with those, what goes up will come down at some point. Now, the question is when. And so also understanding yourself, what happens if you are in a very diversified portfolio, but markets drop considerably? Are you going to be able to ride it out? Do you have cash on hand to make your expenses? I mean, all of these things need to be factored in when we're talking about that.
Well, the bigger issue with all that is, and again, there's so much written about buy and hold investing. Mm-hmm. It depends on three things. One, if you started your buy and hold investing at the peak of 1999, you didn't survive.
Correct.
If you started your buy and hold investing trip at the bottom of 2008, you've done fantastic.
Yeah, you're a rock star,
right? So people always look back as like, oh, if you just held over this very long period of time, buy and hold, you'll do great. As far as diversification, if you've owned large cap, mid cap, small cap, international, emerging markets, in real estate, as an example of that's a typical kind of diversified portfolio. You've vastly underperformed over the last 15, 20 years of just buying and holding an S&P index fund or a NASDAQ fund. I mean, and we're not talking about a small amount of underperformance. We're talking about a massive amount of underperformance. And so the problem is that the buy and hold thesis sounds great. The problem is psychologically, you won't survive it. You're going to wind up, I'm a passive investor and the market's going to go down. And when it goes down 5, 10, 20%, you're going to start selling stuff. And then you're not going to get back in. And so and look, the data proves this out. You can argue with me all day long, but Dalbar have been running studies for over 30 years now. And every year they produce investor returns. Investors consistently underperform indexes because they do everything wrong with investing. They don't know how to take profits. They don't know how to buy bottoms. They don't know how to manage risk. And so they consistently, buy high, they consistently sell low, and they just repeat, wash, rinse, and repeat those same behavioral cycles over time and wind up vastly underperforming markets over time. And so again, this is, it all sounds great in theory. And if you can buy an S&P index fund and sit on it and honestly not touch it and add to it every month, you're going to do fine. You will generate the average rate of return of the index over time. You're not going to beat it, but you'll underperform it because of fees and expenses and taxes, but you'll be close. You'll get close to the average performance of the S&P over time if you can literally just lock it up and not pay attention to it. So it's great. Pistol Pete had an interesting comment here. Where is it? Does it worry us that U.S. Treasury is hugely using Treasury bills, almost all T-bills? Yeah. Why would you not use T-bills right now? If interest rates are high, you don't take on long-term debt at higher interest rates, right? So yeah, you finance everything with using short-term bills on the expectation that rates are going to decline over the next few years because of slower economic growth. As inflation and economic growth return to normal, now that we have all this excess liquidity coming out of the markets, Why would I borrow long-term debt at these rates and lock in higher rates? It's just like if I'm going to go finance something for my business right now, I'm going to use financing on a really short-term basis until rates come down, then I'll lock in long-term rates. Yeah, but you don't do it here. And this was one of my big arguments about the government. When we had interest rates at 1% on the 10-year Treasury, my argument then was, why was the government not refinancing all the Social Security and Medicare and Medicaid debt at 1% interest rates? Right? I mean, you should have just refinanced all of your Social Security, all of your welfare stuff at lower interest rates at that point, just rolled all that debt into very, very low rates for the long term. That would have given you a lot of breathing room. We didn't do that, but could have, right? So dollar debasement trade is real. No, it's not. The debasement trade is not real. It's a narrative. The reason that the dollar goes down in value is, again, we had this whole conversation just recently. We've had videos on this as well. We had a conversation. There's a whole interview series we did on the debasement trade. Your dollar goes down in value because of inflation. That's the only reason it goes down in value. So yes, if you hold your dollars in cash in a jar underneath your bed, yes, it will lose purchasing power over time. This is why you have to invest. That's why you're watching this show. So if you're investing your dollars, there is no debasement trade because your money's going up, keeping purchasing power parity intact. It's easy.
So we've got our Houston area energy retirement using NUA Tax Strategy are mostly just ignoring. The companies that offer that and they allow you to go in and actually pick the tax lots.
That's a great thing.
Oh, it's fantastic. Yes, we're using net unrealized appreciation for our clients on a regular basis. So a detailed analysis is always good to understand exactly what you're doing and then also how you've actually received those funds within that 401k and how they allow you to pay the taxes is really important. But yeah, if you have any questions, go to realinvestmentadvice.com. Happy to spend a little bit more time and go to ask a question. Somebody will certainly give you a call and walk you through that. Great question and something we could probably spend a whole lot more time on, Lance. But we've got a couple more we can get to. This is another really good one. Pistol Pete put this down. So Howard Marks says currently buying stocks at 25 times S&P multiple plus inflation equals annualized losses over the next 10 years. 23 times gets you -2 to +2% over the next 10 years. So that is something we look at often. You look at what, Cape 10, Cape 5 on a regular basis, and that would suggest that the higher that the multiples are, meaning PE ratios, the lower returns will be over time. Now, that does not mean that every year is down. And so I think that's one thing that a lot of people misinterpret about that chart. What it may mean is that we have a couple years, like 2001, 2, and 3, where markets are negative. We may have a 08. Nothing suggests we're falling off a cliff of that magnitude at the moment, but these are things that will occur over time, and we will see, as Lance was going through technicals, we'll see that reversion at some point. Mm-hmm. And that's why, we believe that active money management will beat in a time like this, especially going back to that question about diversified ETFs and passive holding, will likely work better when valuations are this high. So going back to that 1999 versus 2008 argument, very real. And, lots of people love these big, long charts and say, well, look at the market over the last 100 years. It's always gone up. But go back and look at it over 10, 20 year time frames, much different story. And unfortunately, we have a very finite time here. And when we need to use these funds are much different than what the market does. Market doesn't have to take distributions. The market can kick, the index can kick somebody out. We don't have that benefit without taking that loss. So keep that in mind. What else you got here, Lance?
I think we're kind of getting close to the end.
Okay. Perfect. All right, one more. Our Treasury yield supply and demand issue, just like most things, how can global rates decline? Yes and no.
Yes, exactly.
Yeah. Yes, in the sense that if demand is not there, then obviously rates are going to pop up. Global rates, essentially, those are going to be controlled. So right now, we've got an interesting dynamic between the ECB and the Fed, right? We've got central banks have historically always been on the same page and, typically act in unison, where that's not actually going on right now. And, one argument that we've had is that we're still the best house in a bad neighborhood. Yet we're paying more than a lot of other countries. And, that's been the interesting dynamic. Now, the difference is, as the world reserve currency, there's a little bit of difference as far as what we need to do versus maybe another sovereign debt or country in general.
Right. Bizzle Pete said, Howard Marks is currently saying buying stocks at 25 times multiples plus inflation equals annualized losses over the next 10 years. That's partly true. If you take a look at valuation multiples, it suggests that you will have a negative 2% return over 10 years. That does not mean the problem with your statement is when you say annualized losses, because you don't have losses every single year. That is basically, if you started today with $100, you'll wind up at $98 in 10 years. But in the midst of that, you can have big annual years of gains, big annual years of losses, and you wind up at the end of 10 years with a negative loss in total. So again, and if you go back to 2000 through 2013, that's exactly what you saw. A big valuation. If you were buying stocks at 42 times earnings in 1999, you wound up with a zero rate of return 13 years later. But in the midst of that, you had big rallies. You also had two big bear markets. So again, that's what he's talking about, and he's absolutely right. I wrote an article just about valuations recently. And valuations are a big concern moving into next year. You should be aware of what you're paying for valuations on every asset. And, the problem with some assets that people are chasing, it's very hard to apply a multiple to it because it has no earnings, it has no fundamentals, it has no underlying structure. It's simply a speculative trade. So again, that makes it even more problematic when you get into an environment where narratives start to fall apart. And again, all narratives will eventually fall apart for one reason or the other. And that's why it's important to manage the risk. And so, whether you agree with us or not is irrelevant. What our point is that no matter what you're invested in, you have to measure the amount of risk you're taking. And if you're taking a lot of leveraged risk in your portfolio, it's going to work against you at some point. It's just a function of when it occurs. And so again, it's a function of just being careful. There was a question here about, kind of the 60-40 allocation. We've talked about this before. If my goal is to manage a portfolio that generates a rate of return every year, I want to be able to lock up as much of that return and have the least amount of reliance on volatility for return. So again, if my goal is, if Danny comes to me and brings me a client and says, hey, I've got a client here that needs a 6% rate of return, what do you recommend? Take 50% of the portfolio, stick it in 10-year treasuries paying 4%. There's a 2% return annually right there, day one, done. I put the other 50% in equities that have dividend yields, right? So I can create another 3% in dividend yield, so another 1.5% of the portfolio is coming now out of dividend yield. So right there, but when I click on the light switch on January the 1st, that client already has 3.5% of 6% of his return in the cake. We know automatically he's going to get that because of the way the portfolio is allocated. I don't have to worry about it. The bonds are going to mature at face value. I don't have any principal value risk. On the equity
year
side,
to year, but everybody's gonna look at the statements, so keep that in mind.
No. There's no principal value risk if I own a treasury. It may go up and down in value. I may have paper.
Correct.
Paper
That's
changes,
what I'm getting at.
But I have no principal value risk because it matures at face value. And then the only thing I have to worry about is a 2.5% rate of return out of stocks to build out the rest of the 6%. I don't need a lot of volatility risk in that to generate 2.5%. So, it becomes is a 60-40 allocation a good way to manage money? Absolutely. And this is why over the last 125 years, hands down, bar none, 60-40 has outperformed every other asset allocation on record for a reason.
It's so funny. We've talked about this a lot, but you get those articles that come out and say 60-40 is dead. It's never going to make any money again. Things have changed. And then, a month later it comes out and says, oh, 60-40, it's the way to go, right? It's like, oh man, what people do for headlines. But you made a good point. You don't have to agree with everything that we're saying here. And I think that's healthy we take a very pragmatic approach to it, and we listen to a lot of people and read a lot of people with different opinions, because what are we not seeing, right? What is out there that maybe we need to think about differently? And so I think it's great to get different perspectives. But we're taking this very pragmatically and understanding what's going on. How does this impact our clients? What do we need to do and shift with portfolios? And it is very fluid in nature. We can think something today, and that doesn't mean it's going to happen. And tomorrow it could change dramatically based on legislation, big changes within the economy, or big changes with specific companies. So keep that in mind. I think you need to take a proactive approach to it all, and you'll be better off. Now, don't be too proactive where you can also be your own worst enemy.
Right. And again, there's this, we're going to finish up with this one last question because there's a whole bunch going on right now about, bubbles popping and getting out of a bubble ahead of time, those type of things. So bring up this chart for me, Brent. So look, there's no magic bullet about navigating bubbles. Bubbles pop whenever they pop. Are we in a bubble now? Probably. We've had the longest, most advanced kind of secular bull market cycle since 2009 on record, right? I mean, it's just been a very, we're up 500% from the lows. It's been a fantastic bull run. We've got overvaluations on multiple levels. So sure, you can certainly make the argument that we're in a bubble type market, right? But you're going to know when things change if you pay attention to things. So again, I just threw this together really fast. This is a monthly chart, 4-year moving average, just like I was showing you with silver a minute ago. But you'll notice that 4-year monthly moving average has been the running trend line of this market since 2009, right? So coming off that 2009 bottom, when we got above the 4-year moving average, we just traded above that, for that whole period of time. So it's been running as a running trend line now for the last 15 years. So the only thing you have to worry about, and again, what separates a bull market from a bear market is when you break trends. So if this bubble pops, if you go back to 2019, 99, and in 2008, yeah, the market was declining. Yes, you took some losses, but there was plenty of opportunity to determine that the trend of the bull market was now changing, the tenor of the market was now changing, and you needed to reduce risk. Now, if you're just going to buy and hold, yeah, the bubble's going to pop and you're going to ride those down and you're going to lose a big chunk of your money. There's no doubt about that. And a market to return back to, say, the 2020 lows, that's around 3,000. That's not going to be a surprise. That's a 50% loss in the market. So yeah, if you're just going to ride the market down and not pay attention to things, yeah, you're going to suffer a big decline. You're going to lose a lot of money. But it does not take a lot of work and it does not take a lot of magic to follow price and understand price and pay attention to the risk you're taking. If you're taking on a lot of leveraged risk in your portfolio, reduce that. There's a point to where this market will break and you're going to start breaking trends. You're going to start breaking bullish trend lines, bullish support lines. You're going to see a change in the tenor of the market that's going to give you plenty of indication it's now time to leave. Does that mean you're going to get out at the top of the market? Absolutely not. You should not expect to get out of the market at the top, and you should not expect to buy the market at the bottom. The goal is to get that 80%. 80% of the upside when the market's moving up, miss 80% of the downside when the market's declining. If you can do that, you will absolutely crush it over the long term of managing your wealth. So again, these are narratives. The whole bubble, it's a narrative. It's great for getting clicks and views, but it doesn't mean anything because you can't navigate that. If you get out now, this market can still go up for the next 5 years. Now you're sitting on your hands in cash, waiting for the next correction. And that happens to people all the time. These are those psychological hangups that people constantly do that destroy their ability to manage their money over time. So again, this is why we write all these articles. I've got investor resolutions coming up over the next couple of weeks. So if you go to realinvestmentadvice.com, go to the market and commentary section, subscribe to our blog, subscribe to our newsletter. I just wrote the bull bear case for 2026 this past weekend in the newsletter. If you're missing our newsletter, you're missing some of the most important work that we do in terms of managing your portfolio, all of our stats, our data, our gauges. We publish those all in the newsletter every week. And then our blogs, we cover all these topics as you're talking about, these narratives. We cover those topics, those narratives, and we break down the data that either support or reject those narratives. And so this is why, just because you disagree with me is fine, but at least read the work so that you can understand where our positions are coming from, because we use all the data to back up our position. Whether you agree or not, it's irrelevant, but it's just the data that we're talking about. But that's all at the website, realinvestmentadvice.com. Be sure and like and subscribe to the channel. We appreciate you very much hanging out with us today. It's been a lot of fun. We enjoy these Q&A sessions. We'll do them again. Some great questions today. So like and subscribe. Make sure and don't forget, get your ticket to the upcoming Economic Summit. While you're at the website, realinvestmentadvice.com, subscribing to the newsletter and the daily blogs and the daily market commentary. Also, get your ticket for the upcoming Economic Summit coming up January the 17th. Danny will be there, Richard, Ed Slott, America's Financial Planner, myself, Michael Leibowitz. We've got people from BlackRock and DeFi development to talk about AI and crypto. It's going to be a lot of fun, very educational, very informative. January 17th, get your ticket today. They are selling out pretty quick. And we'll see you back here tomorrow with Michael Leibowitz, talk all about the Fed. See you then.